Let me now bring on board Sandeep Bagla, CEO with the Trust Mutual Fund, and Prasad Koparkar, Senior Director with CRISIL. Now, Trust Mutual Fund is coming out with the AMC, and they're starting with a debt scheme. The Indian mutual fund industry is a very crowded market, and there are nearly 4 dozen AMCs in India. So why have they decided to come out with a fund offering at a time when interest rates surely have bottomed out and inflation is a real fear? And how are they planning to really differentiate this scheme from others? To discuss all that and much more, we have the team with us. Sandeep, my introduction perhaps was the question in itself. Why are you coming out with an NFO now? And the fact that you would be the 45th AMC player in India, how will you be different?
When you are launching a mutual fund, you must understand that mutual funds are, going concerns. So these are, I have always said that being in a mutual fund is like being on a treadmill. Once you get up, you can't get down. So any time is a good time to start a business. And there are so many other businesses where there are multiple players. And as long as you have a product which is beneficial to your customers, you have a reason you have a reason for existence. And this time, I would say, is any good time. When I was there in many years back in Reliance Mutual Fund, that time also we felt कि अरे अभी तो बहुत हो गया, we are in the industry. But how that fund has done well. So I think the whole idea is to focus on financial products or investment products for your customers, which are beneficial for them, which help them meet their financial goals. And as long as you are able to deliver a product which is consistent and which is well-researched, which is back-tested, which is giving you good risk-adjusted returns, as long as that you are able to achieve, I think you will be able to find a way. And I think why 45 mutual funds are in the future, there will be many mutual funds.
Now, there is a promise of higher returns by investing in AAA bonds, and you're planning to really keep it very simple by following a methodology of a strategy where the downside really could be minimized. How will you achieve higher returns with your peers by investing in AAA?
When we say returns, we do not mean nominal returns. What we want to offer is higher risk-adjusted returns and risk-adjusted returns which are commensurate with the returns of the underlying asset class. So at no point of time are we saying that we will be the best performing mutual fund in the asset class. We are saying we will be in line with the returns that is given by the underlying asset class. And if you look at it from a volatility adjusted manner or risk adjusted manner, we want to do extremely well. So, we want to bring risk to the forefront. In fixed income, people have been talking about or concentrating on only nominal returns. People, of course, in the recent times, most investors have become aware that the risks in fixed income can also be significant and risks can be real. So we want to bring that risk in the forefront. We want to achieve good risk-adjusted returns for the investors.
Prasad, for the first time, CRISIL, which broadly is a rating agency, has become a knowledge partner for AMC. What is the role of CRISIL in this?
I will first clarify that, CRISIL obviously has a rating business, which is very well known, but the team that is working with Trust is not the rating team, it is a research team, and I'm a part of that. And there is a firewall, complete firewall. In fact, now it's a separate legal entity under the SEBI guidelines. So the areas that we work with, and I think Sandeep spoke about the innovation and being a differentiated product. But what can be a very theoretically very interesting product, very logical, in practice, whether it will work, how it can be executed, it will depend upon how it is tested, refined, retested, using very good quality data, which extends over a period of time and across business cycles. So that is where I think CRISIL comes in terms of our experience, in terms of the mutual fund industry, where we've been ranking mutual funds for over 20 years. the entire fixed income market, where we are the primary valuation agency, valuing more than 10,000 securities every day, the largest agency again. And in fixed income indices, we are again the largest player. We have more than 200 indices now. So that is where I think this entire testing of this concept, while the concept is there, in terms of the refinement, in terms of what exactly is the allocations for individual securities, what can be the weights assigned for them, what is the maturity bucket that they should invest in. Those are the questions that Trust had. And that is where they've come to us. And we have worked with them very closely for about an year.
Prasad, what kind of data stimulation you've done? Because the NFO presentation talks about data mining, where you've run scenarios which essentially talk about complete focus on investment towards low risk and low volatility.
Yes, I think the simulation and backtesting was a very critical component to ensure that what sounds in theory will actually work. And we tested it for actually more than 5 years. So, from 2015 to 2020 data is what we used. And that is where CRISIL's very strong database in terms of ratings, the mutual fund and their indices, as well as the corporate database came in very handy. And we did close to about 23,000 plus simulations on the portfolio, what potential portfolio the fund can have. And I think Sandeep will talk about the limited active kind of a concept that they're coming up with. And the outcomes of this 23,000 simulation was to see under different portfolio construct, how the risk and return will pan out. How will it compare with a benchmark index, say something like a CRISIL's PSU and banking fund index, or the peer set, in the same category. And what we found, interestingly, Mitunj, is that across this 5-year period, on a risk-adjusted basis, certainly a strategy like this on a roll-down basis generated far superior returns in the 5-year period, and not only over a 5-year period, but even shorter period. So we tested for 6 months, 1 year, 2 year, 3 year, and 5 year. Almost in every bucket, this kind of a portfolio, I mean, obviously it was a model portfolio, even adjusted for expenses, generated superior risk-adjusted return compared to peer set and compared to the benchmark.
Sandeep, a very, very basic question. If interest rates at all, they are not likely to go lower, they will only go higher. Inflation, if at all, is likely to go higher, not lower. And there is a serious case that inflation, because of liquidity, because of demand constraints, will make a comeback. So is it a good idea to come out with a debt fund when both the macro factors are against you?
Good question. See, there's always a risk of interest rate risk. There's always a risk of inflation, especially in countries like India, where the supply chains are not able to catch up to demand trends or changes in demand. So that we have suffered in the past also. But often what we have observed, that inflation has come down and settled in and around the 4% range. And RBI's credibility in terms of influencing and adjusting inflation has gone up quite a lot from before. Now, while the current inflation numbers have been higher in the previous months, current inflation has come down to about 4.5. And I think from the market behavior, I think market is feeling that eventually inflation will tend towards 4%. Now, when there have been periods in the market where interest rates have gone nowhere, and they have remained low for a long period of time. So our idea behind this fund is that we are starting with a portfolio of bonds of 3.5-year maturity. As time goes, the maturity of the fund will keep coming down. These are called roll down funds. So the interest rate risk will keep coming down. So probably maybe after 2 years, when interest rates start going up, the duration of the fund would have come down quite a lot. In the interim, the investor would have been able to benefit from the higher interest rates offered by 3 to 4 year bonds compared to the lower bonds. So I don't think this is a bad time for a fund like this. It's a good hedge against interest rates if they go up. But I don't think interest rates are going up in a hurry and by that much.
Prasad, now NFO of a debt mutual fund may not be exactly like equity NFO, where the retail also has a very strong interest. It's a different product with a different positioning for a different segment. So in your analysis and based on your understanding of the NFO and the processes you've done, which pedigree of investors or which perhaps section of investors should participate or should invest in this kind of an NFO?
I think people who are looking for a fairly medium-term horizon, and as Sandeep said, this duration roll down strategy is very unique. We have not really seen many funds of that type in India, even outside. So people who are looking for a 3 to 4 year investment horizon and who don't want to take too much of an interest rate risk, because I think the point that Sandeep made, and also you rightly said, that at some point in time, because of the excessive liquidity as well as potential inflation risk, rates can go up over a period of time. This fund will, on an average, over this 3.5 year period, will have a duration of somewhere close to 2. And when I look at the peer set in this particular category or the benchmark index, it is almost like 40 to 50% higher duration. That means it is relatively much more riskier and sensitive to interest rates going up. So people who don't want to take too much of interest rate risk and too much of credit risk and would be happy to beat the benchmark with some reasonable amount, I think it's a very suitable fund for them. I think it's not suitable for people who are looking for high returns, certainly with a AAA, and that also with additional filters that are being applied. Fund is not here, it's not designed for maximizing returns in absolute terms.
Sandeep, any special reason why you have restricted yourself to a PSU and banking fund?
This is a popular sectoral fund in the debt category called Banking and PSU Debt Fund. As per the definition of SEBI, 80% is invested in banking and PSU. And so we have just launched that fund and we have followed the scheme objectives. And that scheme objectives define the asset allocation. So of course, when we come out with different funds in the future, like the short-term fund, they will not have the same constraint. But because this is a sectoral fund, we have this constraint.
Your back data is suggesting that the risk of downgrade is something we are trying to really bullet-proof your portfolio to. But you never say never. How essentially would you be able to really protect this fund from any credit downgrades?
So the whole fund has been structured to avoid situations like this. If you take notice of all these bonds which got downgraded, you will realize that while the normal AAAs were trading at around 7%, some of these companies, they were trading close to 9%. So their corporate bond spreads were much higher than the normal AAAs. This is an essential part of our design. We are using this market signal that if a bond yield is much higher than the other AAAs, we are simply removing it from our universe. This is part of our filtering process. So we are proactively removing companies which the markets are not treating as AAAs. And since CRISIL will be periodically updating that universe, what will happen is if a company's bond spread starts increasing, we will be removing it from our portfolio before it gets downgraded. So we have built in some, anticipatory kind of signals that are going to help us in our fund management.
Sandeep, what about the fees and the other basic structures, and how exactly are they comparable with the industry?
So there, as Prasad mentioned, that this is somewhere between a passive and active fund. There are two categories of fees right now, two categories of funds. There's one, the regular plan, and there's a direct plan. While the TR, the total expense ratio, can be flexible and can change, at very short notice, initially we are planning to charge 20 basis points for the direct plan, 70 basis points for the regular plan. In the direct plan, typically institutional investors participate, and the fee, I believe, is slightly lower than what the other people are charging.
All right, Sandeep, Prasad, good luck. Thank you for joining us, and certainly hope to see much more of you going forward.